All right, good evening. This is Financial Statement Analysis Group 4, comprised of Roger, Andre, Khai, Pasha, and Jeff. We'll be looking at the Craft Beer Alliance versus Boston Beer Company. So looking at the first slide, you can see the craft beer industry as a whole, specifically the time period 2004 to 2016. What I'd like to draw your attention to from this slide is the fact that early on in the industry, we had nice steady growth followed by an explosive period. And now in the present, what we see is flattening growth within the industry. This is also illustrated by the following two slides showing both production and then year-over-year growth versus retail sales. So as you can see, essentially exponential growth in the early 2000s, and now again a mature phase in the industry with flattening production. The number of breweries on the right is a little bit misleading, as we'll talk about during the SWOT analysis. Yes, there has been a decrease since about 2013. However, the trend is actually increasing from 2016 to the present. Okay, so looking at our SWOT analysis, looking at the craft beer industry, we found some of its strengths to be global growth and even decent growth within the U.S. The actual demographic strength that it has behind it in terms of who is drinking craft beer, and then ultimately the rise of the rest, or the rise of the developed economies and the middle class within them. So specifically those points, the bulk of the drinkers of craft beer, 21 to 35-year-olds, so essentially the millennials. For overall global growth rate, we're looking at about 7.02%, with the U.S. at 6.88%. Specifically. So that's going to be the growth rate that informs our projections, which we'll discuss here shortly. In terms of weaknesses, as the graph illustrated, the biggest weakness is we're reaching the point of saturation. So saturation is being compounded by overall industry competition increasing. Just between 2015 and 16 alone, the number of craft breweries increased by 17%. So that was a result of 1,300 new breweries coming online. The problem is 2,700 other breweries are in the works behind that. So competition continues to increase while overall demand remains flat. For opportunities, the beer market itself is huge. Even if we look specifically at the craft beer market, that too is a significant market at $23.5 billion, or 21.8% of the total beer market. Overall growth is impressive at 10%. Again, going forward to 2023, we expect that to continue to decrease to about 6.88 in the U.S. About the only real headwind, tailwind for the craft industry at present is tax reform, which has significantly dropped the corporate tax rate to include relief of excise taxes. Okay, so overall, we see the threats to this industry being flattening sales. We've talked about those growth figures. And the fact that competition continues to increase unabated. So at this time, I'll turn it over to Khai, who will discuss the pertinent differences between Craft Brew Alliance and the Boston Beer Company. Khai?
Thank you, Andre. For my section, I'm going to go into the comparison between Craft Brew Alliance and Boston Beer and one of its competitors. I'm going to talk about the growth, the profitability, mainly the profit margins, and return on investments. Looking at this slide, you can see that the sales growth, the operating income growth, and net income growth for a craft is not only deteriorating, it's actually worse than its competitor. This reflects the trend, the macro trend that Andrew talked about, the slowing in industry, but operationally, in performance execution-wise, craft is doing worse than its competitor. Turning over to the profit margins, and all the key margins that you see in front of you, the gross profit margin, the operating income profit margin, and net income profit margin, are essentially flat. It's not improving, meaning the company is not improving, it's not scaling its operations, and it's lags behind the Boston Beer Company. Not only lags, but lags by a significant margin. Turning over to return on equity and return on assets, as you can see here, it's not surprising if the company has no profit, then its return on equity and return on assets will be very challenging. It essentially, it hovers around zero. And decomposing the DuPont analysis, breaking down the return on equity, you can see that leverage, or assets over equity, the interest efficiency, the profit margin as defined by NOPAT divided by sales, and asset turnover, the company it reflects these metrics clearly explain why its return investment is so poor. I'm going to turn over to Roger, who's going to talk about the key value drivers and how they translate into our scenario.
Building on the analysis that Khai and Andre described, we identified a number of key value drivers for Craft Brew Alliance. In particular, we identified the distribution alliance that the company retains with Anheuser-Busch as critical to scaling its long-term operations, also something that potentially offers constraints in the long term. We also identified an interesting dynamic between the company's interest in growing a long-term national profile with diversity across the country, while at the same time, many of its most successful brands are very regional in nature, dependent on retaining a spirit of authenticity to remain profitable. The most important thing from these value drivers, of course, was finding a way to translate them into an understanding of assumptions for the current and future performance of the company. To capture this, we envisioned three scenarios for the firm that recognized bearish, bullish, and expected assumptions for key performance metrics. Based on our analysis of the Craft Brew Alliance relative to the Boston Beer Company, we felt that the craft brew industry as a whole may be reaching maturity with slowing sales and increasing competition. So we opted to focus primarily on the bear scenario for our analysis. Of particular interest to our firm in creating a viable bear scenario was understanding how those value drivers would translate into an understanding of the firm's sales growth from both a macro and a micro perspective. From a macro perspective, we assessed the firm's performance within the broader landscape of the beer industry. We noted the relatively high 6.88% growth rate for craft brewing shipments projected into the future compared to the 0.25% relatively flat average growth rate for the beer industry as a whole. While the 6.88% figure was tempting, we opted to go more conservative. Our bearish instincts compelled us to give ourselves grounding based on the fact that for the last several years, Craft Brew Alliance had remained consistent at about 0.35% of the total beer marketplace nationwide. Converting this assumption moving forward forced us to look at bearish estimates for total shipments that were relatively flat at about 730,000 barrels per year. From a micro perspective, we were concerned more about value drivers suggesting the firm's future margins would be constrained by its dependence on the distribution alliance with Anheuser-Busch. This affected our projections in a number of ways. First, in converting the total shipment estimates to sales by multiplying them by a reasonable unit price estimate, we opted to go conservative. Instead of the average 2.8% unit price growth for the last several years, we instead anticipated slower growth in the average unit price of 1%. When we did the math, this led us to overall estimates of relatively slow overall sales growth, stabilizing to about 1.25% by 2018, 2019, and 2020. Positive, yes, but lower than overall GDP projections over the same period. The baggage of the Anheuser-Busch contract, as well as the weight of the company's dependence on maintaining a national presence and diversity of brands, as well as the fact that it needs to continue to prop up brands like Kona in order to maintain its overall growth, but it's to further anticipate no foreseeable improvements that we might have otherwise expected in cost efficiency related to the cost of goods sold, or SG&A. In other words, we anticipate the company will continue to grow somewhat like a startup moving forward. In our bearish projections, we grew these line items consistently in relationship to costs. I'm going to turn it over to Pasha now, who's going to talk a little bit more about how these projections translate into our pro forma financial statements.
Thank you, Roger. For our performance statements, we made reasonable assumptions, some of which you can see right here. This is our statement of operations or income statement. The numbers in orange are our projected pro forma figures. This is our balance sheet and the pro forma balance sheet in orange. This is the statement of cash flows, and again, the pro forma numbers in orange. The main assumption that we made here is the CapEx, the maintenance CapEx figure, which we assumed to be equal to depreciation and amortization. In other words, the company is going to maintain its current PP&E. And most of the figures in our three pro forma statements were driven by the calculations and assumptions that you can see here, which are mostly driven by as a percentage of sales. And Jeff is going to take you through the actual valuation and our conclusion.
Thank you, Pasha. Using the residual income valuation model with a starting book value of $119 million, a discount rate of 10%, and our forecasted bear scenario, we calculated an equity value of Craft Alliance at the beginning of 2017 of only $18 million. That's only 94 cents per share. This is very low, below book value. We also checked this with a valuation method using free cash flow and continuing value using NOPLAT and return on invested capital, and got very similar results. But this makes sense. If you are getting a return on equity of 2.7% when the required return on equity is 10%, then this essentially becomes negative. Then for every year that the firm is operating at this low level of productivity, it is destroying value for its investors. And it can't grow itself out of this scenario unless it improves its return on invested capital. In order to escape this bear scenario, they somehow need to change their business model. They would either need to sell more beer with the same number of assets, or increase their profit margin by decreasing costs or increasing prices. Levering up with cheap debt may increase return on equity, but it would also increase the return on equity required by investors. The ability to sell more using the same invested capital or extract a higher profit margin gets back to the necessity of having some sustainable competitive advantage. In this bear scenario, if it could not gain some competitive advantage and does not anticipate being able to obtain a return on invested capital of 10% in the future, then it should sell off its assets and the company should distribute the cash to its investors.